Welcome to The Explainer. You know, every single trading day, hundreds of billions of dollars worth of stocks change hands on American markets alone. I mean, it is a staggering amount of wealth in continuous motion. But despite all that money flying around and dominating the daily news cycle, the foundational nuts and bolts of the stock market remain pretty widely misunderstood by the general public. So today, we're breaking down the source material to reveal how the whole shebang actually works.
Okay, let's dive right into this with a massive misconception right out of the gate. Does Apple get your money when you buy their stock? Well, most people kind of assume the stock market works like a giant corporate donation box. They mistakenly think that when they buy a share for $200, Apple directly pockets that cash and immediately uses it to build the next iPhone. But according to our sources, that is almost completely wrong.
The reality is actually much stranger. When you hit buy on your phone, Apple doesn't even know you exist. They don't get a single cent of that transaction. Instead, you're literally just handing your money to a complete stranger. You're paying someone you'll never meet who just happened to decide that today was a good day to sell their Apple stock. Yet, that invisible transaction between you and a stranger still moves numbers on a screen, makes headlines, and shifts the retirement savings of millions of people in a fraction of a second. Crazy, right?
Section 1. The origin of shares. To really understand why this somewhat unusual system exists in the first place, we need to step back to Amsterdam in 1602. Just imagine you're a merchant seeking lucrative Asian spices. Under the old way, one wealthy person takes on all the astronomical risk to fund the voyage, facing total devastating ruin if the ship sinks. But the Dutch East India Company pioneered a brilliant new way, dividing the ownership. Instead of one person risking it all, dozens chip in. If the ship returns, everyone shares the profit proportionally. If it sinks, no single person is completely ruined. This simple idea of splitting risk and reward laid the absolute foundation for all modern trading.
So a stock today is really just a modern version of that 17th century ship. It's an abstract claim on the future value of a business. Think of it like owning a slice of a pizza that hasn't even been baked yet. You don't get to walk into an Amazon warehouse and start handing out boxes. But if the whole pizza grows, like if the company expands into new markets and earns more money, your slice grows right along with it. And for sure, if the pizza burns, your slice burns too. True ownership means sharing in both the upside and the risk.
Section 2. Primary versus secondary markets.
When modern companies want to scale operations and expand, they need massive capital. Instead of taking on highly restrictive bank debt or relying entirely on wealthy private backers, they turn to the public through an IPO, or initial public offering. Remember our donation box myth from earlier? Well, an IPO is the one specific, super rare moment where your money actually does flow directly to the company's bank account to fund their growth and acquisitions.
We really have to draw a hard line here. That IPO is part of the primary market, where money flows straight from investors to the company. But the secondary market is literally everything that happens after. Once those initial shares are out in the world, the company steps completely aside. From that point forward, investors are just trading shares back and forth with each other, and the company is merely a bystander. The stock price you see isn't a measure of the cash the company holds. It's a measure of what investors currently believe the company is worth.
Section 3. The matchmaking system.
If you're just trading with other investors in this secondary market, how do you actually find them? Rather than a chaotic physical trading floor, think of modern exchanges like the NYSE and NASDAQ as incredibly regulated, lightning-fast digital matchmakers. You hit buy on your app, your broker instantly routes that order to the exchange, and sophisticated software scans the global network to find a willing seller at exactly your price. The trade settles in milliseconds, connecting parties seamlessly and updating the price for the whole world to see.
Section 4. Who actually trades stocks?
So who exactly is interacting within this digital matchmaking system? Well, it's not one homogeneous crowd at all. It's a highly diverse, bustling ecosystem. At the top, you've got retail investors, regular people holding shares long-term in companies they believe in. Next are the traders, operating in high-stress, short-term environments to profit from quick price swings. Then we have the true heavyweights, institutional investors. These are your pension funds and hedge funds managing billions, sometimes trillions of dollars, whose massive trades can literally shift the entire market. And finally, market makers. They sit on both sides of trades, profiting on tiny spreads to crucially ensure the market always has the liquidity it needs to function smoothly.
Section 5. How prices really change.
With all these wildly different players, from retail apps to trillion-dollar hedge funds constantly throwing money into this matchmaking system, what actually dictates the ever-shifting price you see blinking on your screen? Well, it all boils down to the classic fundamental forces of supply and demand. Every single stock out there has two crucial numbers attached to it at any given millisecond: the bid and the ask. The bid is the highest price a buyer is currently willing to pay. The ask is the lowest price a seller is currently willing to accept. When a buyer's bid and a seller's ask finally meet in the middle, a trade happens. And boom, that exact matching point becomes the official latest price of the stock.
Simply put, it's a constant tug of war. If buyers outnumber sellers, those buyers have to start competing with each other. They offer higher and higher prices to convince someone to let go of their shares, which naturally drives prices up. On the flip side, if sellers panic and outnumber buyers, they're forced to undercut each other. They slash their asking prices just to attract a buyer and offload their shares, driving prices way down.
But here is the ultimate twist that dictates price movements, and this is exactly what trips up so many people. The market isn't just reacting to what a company has already done. It is constantly pricing in expectations, not just reality. When you buy a stock, you aren't just buying the present state of the company. You're buying what the collective crowd thinks the future looks like.
This explains the most mind-bending realities of financial news. It's exactly why an expected disappointment can cause a stock to drop weeks before a single bad financial number is actually reported. It explains how a startup with zero revenue can secure $1 billion valuation purely because enough people believe in its future potential. And perhaps most frustrating for new investors, it explains why a company can post record-breaking profits only to watch its stock immediately drop, simply because those profits, while good in reality, miss the market's sky-high expectations.
As we wrap up this explainer, I want to leave you with this final, provocative thought regarding the invisible strangers and future predictions waiting on the other side of your screen. The next time you open your trading app and tap buy, pause for a second and ask yourself, what expectations are you really buying into? Are you betting on the concrete reality of the company today? Or are you buying into the world's hopes for its tomorrow?